Welcome back to our Great Wealth Transfer series. This is episode 4, and by the end of this episode, you'll see the 25-year math on a single Alberta rental property and understand why it's a different category of legacy than anything sitting in a savings account.
So we're going to start with a story. There was a couple in Edmonton who bought a duplex in 2002. They paid $148,000. This couple, they weren't investors. They had some equity in their home. A friend mentioned they should get in the rental market, and the numbers seemed to make sense at the time. They rented it for 21 years. They fixed the furnace twice. They replaced the roof once. They slowly raised the rents over those 20 years, and they mostly just let it run itself. Their son had no idea that this property even existed. He found out at a family dinner when his dad mentioned he was thinking about selling it and putting the money into a GIC. That property, the one his dad almost sold, is worth $600,000 today. And the conversation it started changed his family's financial trajectory for the next 20 years.
And most families treat investment real estate like retirement asset. Something you hold, collect rent from, and eventually sell. The families who actually preserve wealth across generations think about it differently.
Now, before we go any further, nothing in this series is legal, tax, or financial advice. We are real estate operators in the Calgary market. Our job is to give you the vocabulary and the context. Ultimately, the decisions are yours.
A lot of other wealth transfer tools, like cash gifting, trusts, estate planning, involves moving something you already have. Investment real estate's different. You're building the legacy asset over a long period of time. And while you're building it, it's paying you.
A rental property in Alberta generates actual cash every month. That income can cover your costs in retirement, can be reinvested, can be distributed to family members in a tax-efficient way. And at the end, when you do decide to transition it, it carries decades of equity that it built largely on its own.
So the model a lot of traditional estate planning teaches is to accumulate and then distribute at death, instead of buy, hold, cash flow, and plan the transfer before the estate forces decisions.
And there's a number that puts this into context.
In 2001, the average home in Edmonton cost around $124,000. If you had bought one as a rental that year and put $25,000 down and rented it out, today that property is worth probably over $600,000. Your tenant paid down their mortgage the entire time. You collected rent the entire time. That's going to be over a 400% return, while inflation over the same period was about 238%.
And that's the compounding power of investment real estate as a legacy tool. You're not just preserving wealth, you're building it while being paid along the way. Now, the reason we focus on Alberta specifically is cash flow. In Toronto or Vancouver, you buy a $2 million property and you're going to lose money every single month as a rental. You're betting entirely on appreciation in markets that have already inflated tremendously over the last decade. The math in Alberta is different.
Calgary detached homes are sitting around $750,000. Edmonton's around $600,000. Even lower, you can get stuff in the 530s still. So lower entry prices, and Alberta rents still support positive cash flow on well-chosen properties. You're not just hoping the asset appreciates, you're being paid while it does. And Alberta has no rent control. In Ontario, BC, Quebec, landlords are capped on how much they can increase rent even as their own costs rise. In Alberta, you can adjust to market between tenancies. Your income stream isn't artificially frozen by anybody else. Alberta's secondary markets deserve a lot of attention too. So Airdrie, Cochrane, Okotoks, Chestermere, even further out. Lot lower entry prices in Calgary, strong rental demand, tight vacancy driven by Calgary employment proximity, and for families building the first investment property as a legacy asset, these markets deserve serious looks.
And the property management question and managing a rental property, it comes up every single time.
So property management in Alberta runs, anywhere from 8 to 12%, usually around 10 right now. On a $2,000 rental, that's, let's say, $160 to $200 a month. So you're still cash flowing positive on most Alberta properties after all of your fees. You own that asset, and someone else can run it for you.
Now here's the part most people who own rental properties have never fully worked through. The asset you've been building, the one that's been generating income and appreciating for 20 years, has a tax reality attached to it that most families don't see until they're inside an estate settlement. And by then, it's unfortunately too late to plan around it.
When you die, the CRA treats your investment property as if you sold it at fair market value the day before you passed. That's the deemed disposition rule, the same one we cover in episode 2 of this series. So every dollar of appreciation you've built up over the 20 years is treated as a capital gain in your final tax return.
So we're going to give you real numbers. You buy an investment property in Calgary today for $750,000. You hold it for 20 years. Maybe it's worth $1 million to $1.2 million at the historical Alberta appreciation rates. So in that case, you have a $400,000 to $500,000 capital gain. In 2026, the tax on that, before your family sees anything, could be north of $150,000.
And if the estate doesn't have liquid assets to cover that, so no life insurance, no accessible savings, the executor may have to sell the property quickly just to pay the CRA's bill. The asset you built as a legacy in that case ends up being liquidated to cover the tax on itself.
Which is exactly what the Edmonton couple almost let happen without knowing it. Now, if this is landing, subscribe before we keep going. Episode 5 covers real estate as an inflation hedge. The data on why Alberta property has outpaced inflation by over 130% over the last 25 years. Make sure you subscribe so you don't miss it.
Like this video if you can, share it with somebody that needs it. And now here's what that Edmonton couple actually did, and the 3 options every family has in situations such as this. Okay, so let's put the math on the board because this conversation is what most families with investment real estate haven't had yet. So up on the board, we have option A and option B. Same starting point. Let's say $125,000. And this is in 2001. So option A, you put it into a savings account, GICs, average 2% return over the 25 years in this case. If you did that today, you would have roughly $206,000. In nominal terms, you've made some money. But inflation over the same 25-year period we just talked about was 238%. Your $206,000 buys less than your original $125,000 did in 2001. You've saved faithfully and you're losing ground. And even if we use better investments on the market, let's say 6 or 8%, you're still gonna lose ground in this case. All right, option B is the same $125,000 as a down payment on a property. The property now is worth $600,000 or more. Your tenant has paid the whole mortgage and you collected rent for 25 years. The asset's still here, it hasn't been consumed, and it's available to transfer to somebody.
Now, this is a different category of legacy. The cash here got spent or eroded. The property here is still standing today. So what did the Edmonton couple actually do? Once the son understood what the property was worth and what the tax exposure looked like, they had a real conversation for the first time.
So they had 3 options, and these are the same 3 options most families in this situation have. Number 1, bring the adult child onto the title now. Co-ownership from this point forward. The son contributes what he can, they split the rental income, and over time the parents gradually transfer their share. The son builds equity in a real asset while his parents are still alive to guide him through it.
And the key principle here is the son now learns how to operate this asset and understands everything about the asset so that we don't lose our generational wealth like we covered in our last episode.
Now the second option, hold the property inside a family trust. We go deep on this in the next episode. The short version of it though is assets in a properly structured trust can bypass probate, allow income splitting among family members, and give the parents control over how and when the property eventually transfers.
The third option, and this is the one most people skip, is life insurance. Specifically a policy size to cover the estate's capital gains tax exposure. The Edmonton property is going to trigger a significant tax bill when both parents die. Life insurance means the estate has the cash to pay it without forcing a sale of the property that triggered the tax in the first place.
These 3 strategies aren't mutually exclusive. The families who do this really well often use all 3 in combination. Co-ownership to build equity and education, a trust to hold the structure efficiently, and insurance to handle the tax liability at death.
And none of this is available if you wait until the estate is being settled. We can't stress this enough. It requires planning before the conversation becomes urgent. That is the variable. That family in Edmonton that we talked about, the father almost sold the duplex, put the money in a GIC. He could have retired quietly and never said a word about it. Not because he didn't care about his son, because he didn't know it was a conversation even worth having.
Most families don't think of the rental property as a legacy tool. They think of it as a retirement asset, something to liquidate when the time comes for them.
And there's nothing wrong with that, but if you're sitting on 20 years of appreciated real estate and your children are in their 30s renting in a market you helped build, it's worth asking, is this just my retirement plan, Or is it something that could change the next generation's trajectory entirely?
The difference between those two outcomes isn't the asset, it's this conversation.
The fact that you just spent time thinking about this genuinely puts you ahead of most people.
Most families never have these conversations. We just gave you some tools to get that started for you.
Now, if you want to take it further, we're always up for a conversation. The link to connect with us is down in the video description below. And episode 5, real estate as an inflation hedge. Alberta property hasn't just kept pace with inflation over 25 years. It's beaten it by over 130 percentage points. We're going to show you the data and what it means for the wealth that you're planning to pass on.
Subscribe to our channel so you don't miss any of the next episodes. Share this video with somebody who needs to see it, please. And we'll see you on the next one.